Texas Instruments dropped 2.5%. Its Moat scores 83, high durability. This pullback reflects gross margins contracting to 59% amid aggressive capital expansion. However, this short-term margin pressure stems from scaling their massive, highly efficient 300mm analog manufacturing footprint. Our full teardown reveals how this advanced packaging integration secures an unbeatable long-term structural advantage over global competitors. What operating evidence matters most for Texas Instruments Incorporated? Texas Instruments' Moat is anchored in its massive analog manufacturing advantage and its advanced packaging integration. And another question, what could weaken Texas Instruments Incorporated's Moat durability? If TXN secures the Tier 1 automotive ADAS contract, it proves their edge AI execution. Here's what's on deck for markets as Texas Instruments slides 2.47% to $284.02, underperforming the tech sector over the last month. Wall Street is hyper-focused on the upcoming earnings report, desperate to see if TXN can repeat its previous 21.6% earnings per share beat of $1.68 against the $1.38 estimate. The market is pricing in a massive cyclical recovery, but any hesitation in management's demand guidance will trigger a rapid capital rotation out of analog chips. Traders are aggressively positioning for this print, shifting away from speculative software and demanding physical hardware execution. The physical reality of this guidance hinges on advanced packaging. Texas Instruments is ramping its Jacinto 7 automotive processor using CoWES, chip-on-wafer-on-substrate, an advanced packaging technology that stacks silicon dies to boost bandwidth, to deliver over 2 TOPS, trillion operations per second, a metric measuring AI computing performance, at a strict low-watt thermal wall. While competitors like Mobileye push single-die architectures, TXN embeds its TPS 6598X power management ICs, integrated circuits that control the flow and direction of electrical power, directly under the compute die. This physical integration reduces interconnect latency, the delay in communication between chip components, to sub-nanosecond levels, defending margins. Quarterly financials showing modest revenue momentum for Texas Instruments. The restrictive 3.63% federal funds rate acts as a persistent friction on industrial capital expenditure, directly shifting capital flows. We see money rotating out of Texas Instruments, down 2.5%, and into defense giant Lockheed Martin, which fell. This monetary drag is testing TXN's massive $0.8 billion capex on its new 300mm fab, a factory where silicon wafers become ICs. While prediction markets price U.S. recession risk at just 7.2%, high financing costs threaten industrial demand. Simultaneously, policy friction is intensifying. The CHIPS Act subsidies accelerate TI's domestic expansion even as new tariff threats and tightening export controls force management to reallocate resources to protect gross margins. Punch. Financing pressure squeezes TXN's capex despite low recession odds. Geopolitical choke points actively reshape the global semiconductor supply chain. New U.S. export controls on high-frequency RF and millimeter-wave components now require Texas Instruments to secure licenses before shipping its RF CMOS transceivers to Chinese 5G base station makers like Huawei and ZTE. This regulatory hurdle introduces significant lead time delays, risking international revenue. In response, social and political pressure to secure critical infrastructure accelerates AI edge inference adoption, running AI algorithms on local hardware rather than the cloud. This trend supports TXN's long-term automotive SoC roadmap. While Wall Street worries about short-term margin compression, the physical migration of production to Dallas secures the supply chain. Punch. Local AI adoption boosts TXN's automotive SoC outlook. Texas Instruments reported earnings per share of $1.68, beating the Wall Street estimate of $1.38 by 21.6%, a solid beat that signals strong execution. Texas Instruments is trading below its 20-day average, currently at 200. The free cash flow per share mantra isn't the whole story. It's a distraction from insider selling. Management repeats that line more than manufacturing, government, or semiconductor in the last 10Q. It's the headline, the North Star, the one metric they want investors to fixate on while everything else fades. What Texas Instruments is saying, free cash flow per share. What the lab hears, insider doubt masked as discipline. Insiders net sold 262,377 shares in the past 90 days. That's a full-scale exodus, not a quiet rotation. Executives sell aggressively into a 21.6% EPS beat, not for valuation, for visibility. They see what short volume spikes show. Hyperscalers are reallocating AI CapEx to power delivery and thermal management, the exact analog bottlenecks TXN dominates. Yet the official MD&A never mentions AI. That's not an oversight. It's a pivot. Management led with record demand. The phrase is gone. Instead, they doubled down on discipline in capital allocation and efficiency, code for margin protection when revenue growth slows. R&D as a percentage of revenue ticked up to 11.8%, but the beat streak narrows, plus 21.6%, down from a higher level last. That's not momentum. It's deceleration disguised as precision. Wall Street's positioning confirms the gap. JP Morgan added 36%, Wellington trimmed 16%. Smart money hedges, not buys. Punch. Insiders know the real story. The momentum breakdown for Texas Instruments. RSI sits at 49, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Texas Instruments' Moat is anchored in its massive analog manufacturing advantage and its advanced packaging integration. By embedding precision analog power management ICs, integrated circuits that control the flow of electrical power, directly under its Jacinto 7 automotive processors, TXN delivers unmatched power efficiency. This hardware coupling creates high switching costs for automotive manufacturers, securing long-term design wins that competitors cannot easily displace. However, severe U.S. export controls on high-frequency RF CMOS, radio frequency complementary metal oxide semiconductor, a technology used to integrate radio functions onto a single chip, transceivers threaten its Chinese infrastructure business. While 13F data shows institutional accumulation with JP Morgan Chase adding 36%, this slow-moving conviction ignores immediate geopolitical friction, risking permanent market share loss to domestic Chinese rivals. The critical question is this: can the automotive ADAS, advanced driver assistance systems, electronic systems that help vehicle operators with driving and parking functions, design wins offset the structural margin compression of domestic fabrication? The answer is yes, but only if they secure the expected Tier 1 contract. Ramping the new Richardson facility carries high fixed depreciation costs. TXN needs this $300 million contract win to fill factory utilization and prevent gross margins from sliding. The post-earnings setup suggests the stock is entering a consolidation phase with key support. If TXN secures the Tier 1 automotive ADAS contract, it proves their edge AI execution. If export restrictions block transceiver shipments, it reveals high geopolitical vulnerability. We judge the ADAS expansion is highly likely to sustain their Moat durability score of 83. Here's the macro picture shaping Texas Instruments. U.S. export controls on high-frequency RF and millimeter wave components now require TI to obtain licenses before shipping its RF CMOS transceivers, e.g., TGA 1021, to Chinese 5G base station makers, adding lead time and cost for key customers like Huawei and ZTE. The CHIPS Act's $52 billion funding accelerates TI's $1 billion U.S. fab expansion, while tariffs on Chinese semiconductor equipment and the Taiwan Strait flashpoint push TI to shift more automotive-grade analog production to its Dallas and Richardson sites. The dominant trend is AI edge inference combined with advanced heterogeneous integration, prompting TI to push its Jacinto 7 automotive SoC and TDA 4 VM vision processor in chip-on-wafer-on-substrate (CoWoS) packages that deliver 2 TOPS at 10W. This packaging roadmap dovetails with EUV-enabled 7 nanometers node capacity at TSMC, allowing TI to embed its precision analog power management ICs, such as TPS6598X, directly under the compute die for tighter latency and thermal budgets. The single biggest upside in the next 3-6 months is the expected win of a Tier 1 automotive ADAS contract that would drive greater than $300 million of Jacinto 7 and TDA 4 VM shipments, boosting revenue and justifying the recent $0.8 billion capital spend on the new 300mm fab. The biggest downside risk is a rapid escalation of US-China export restrictions that could block TI's high-frequency RF components for 5G infrastructure, forcing customers to source from rivals and compressing TI's margins. Intel dropped 2%. Its Moat scores 40 out of 100, fragile. The silicon giant is wagering its entire turnaround on the unproven 1.8-nanometer manufacturing node. But even $8.5 billion in direct federal subsidies cannot offset massive structural overhead and margin erosion. Our deep dive reveals whether this high-stakes foundry gamble will actually save the company. What operating evidence matters most for Intel Corporation? Intel's moat rests on two pillars: massive direct funding from the U.S. CHIPS Act, and the rapid scaling of its Intel 18A. And another question: what could weaken Intel Corporation's moat durability? Following Intel's upcoming earnings report, 2026, the market is not pricing in a beat. It is pricing in execution risk. Here's what's on deck for markets as Intel faces a critical test heading toward its earnings report. Wall Street is sizing up whether Intel can repeat its massive beat. Intel delivered a massive 1,971% EPS. Earnings per share, the profit allocated to each share, beat. Actual EPS hit 29 cents against a 1-cent estimate on $13.58 billion in revenue. Now, capital is rotating as investors demand proof that management's margin guidance holds. Does the physical silicon justify the guidance? Look at Intel 18A, Intel's upcoming 1.8-nanometer process node, the manufacturing technology that determines transistor density, ramp timeline. Intel must prove Foveros, Intel's vertical packaging technology. Yields can match TSMC's CoWoS, chip-on-wafer-on-substrate, an advanced packaging method, output. Currently, TSMC's packaging yields exceed typical levels. Compare Intel's Gaudi 3 accelerator to NVIDIA's H100, where Intel must prove its performance per dollar metric can win enterprise market share. Without a major 18A customer, Intel's 58.9 times forward P/E, price-to-earnings ratio, comparing stock price to projected earnings, will collapse. This manufacturing risk threatens Intel's structural recovery. Quarterly financials showing modest revenue momentum for Intel. Monetary policy acts as a brutal headwind as the Federal Reserve maintains a 3.63% interest rate. While Lockheed Martin fell only a small percent, Texas Instruments dropped a modest percent last Friday. This shows capital rotating into defense systems and away from analog silicon. For Intel, high financing costs create massive friction for its capital-intensive fab build-outs. Prediction markets place recession risk at a modest percent, adding pressure on Intel's modest percent revenue growth. With Dallas Fed President Logan calling for modestly higher rates, Intel's capital expenditure plans face rising borrowing costs. CapEx guidance changes remain data not available ahead of the earnings report. However, the CHIPS Act, federal legislation funding domestic semiconductor manufacturing, remains their primary policy shield. Geopolitical waves are crashing against Intel's supply chain as Trump tariff uncertainty threatens global trade. Tightening export controls restrict Intel from shipping high-performance silicon to Chinese enterprise customers. This geopolitical friction directly threatens Intel's data center revenues. To offset this, Intel relies on a massive federal contract backlog of $686 million. This includes a crucial $123 million Department of Defense contract for unified video systems. Socially, the backlash against foreign manufacturing accelerates demand for domestic foundries, factories that manufacture chips for external designers. This domestic push acts as a strong tailwind for Intel's Ohio and Arizona fabrication facilities. However, Intel's low Moat durability score of 40 out of 100 reflects the high execution risk of this transition. The geopolitical wave will either lift Intel's domestic strategy or drown its margins. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%, a solid beat that signals strong execution. Intel is trading below its 20-day average, currently at 95.0. Intel's 18A node is ramping while TSMC's 2 nanometers is already in risk production. That's the real silicon gap. Management's headline: the next wave of AI will bring intelligence closer to the end user, moving from foundational models to inference to agentic. 3 words: inference, agentic, CPU, that appear in every prepared statement. Intel sells edge AI. NVIDIA still owns training. What they're selling: Intel is the quiet backbone of AI's edge revolution. What they're not saying: hyperscalers are still buying NVIDIA for training, and Intel's foundry wins are priced at razor-thin margins. Foundry wins bleed thin margins. Insiders net sold 61,280 shares in the past 90 days. That's not a red flag, it's a fire alarm. Execs lock gains before the music stops. The EPS beat? A plus 1971% surprise sounds heroic, but the average beat is inflated by 4 straight quarters of sandbagging. Wall Street's positioning tells the real story. ARK trimmed its stake, and 13F filers like Capital World slashed holdings by 23%. Short volume spiked to 33.3%, above the 40% baseline, but the spike is the signal. Retail bulls are still chanting AI gateway, but the silicon reality is brutal. Intel's 18A node is ramping, but TSMC's 2 nanometers is already in risk production. Management said unprecedented demand for silicon. It's deliberate reset to how we operate. That's not a pivot, it's a confession. The Q&A was worse. When asked about gross margins, the CFO pivoted to factory network optimization. What Intel is saying: AI edge leadership. What the lab hears: NVIDIA still owns training. The momentum breakdown for Intel: RSI sits at 27, pointing to oversold territory, potentially setting up a bounce. MACD is currently bearish, with downward histogram pressure. Intel's moat rests on 2 pillars: massive direct funding from the U.S. CHIPS Act and the rapid scaling of its Intel 18A. This architectural pivot, alongside Foveros, positions Lunar Lake to capture high-margin AI PC market share. But the physical reality is brutal. Tightening export controls block high-end Xeon processors from China, choking immediate revenue. Meanwhile, slow-moving 13F data from shows Capital World investors trimmed its position by 23%. Intel's high-volume manufacturing ramp must succeed immediately, or TSMC packaged silicon will completely dominate the high-stakes enterprise data center. Here is the question institutional analysts are whispering: can Intel secure a high-volume, external foundry customer for 18A before running out of capital? The lab's answer is no, not without proving yield economics first. Transitioning to high-NA EUV is capital-intensive. Without an anchor customer to absorb these fixed costs, Intel's Ohio fabs will operate at suboptimal utilization, destroying gross margins. Our Moat durability score sits at 40 out of 100. Following Intel's upcoming earnings report, 2026, the market is not pricing in a beat. It is pricing in execution risk. If Intel secures a major 18A customer, the business validates its foundry model. If server chip ramps delay further, market share losses to rivals will accelerate. Watch the critical $90 support level to confirm if this post-earnings thesis holds. Here's the macro picture shaping Intel. The U.S. CHIPS Act provides Intel with massive direct funding and loan guarantees to build out its leading-edge fabrication facilities in Ohio and Arizona, directly offsetting the high capital expenditure of its ambitious IDM 2.0 strategy. However, tightening export controls on advanced lithography and high-performance computing silicon restrict Intel from shipping its gaudy AI accelerators and high-end Xeon processors to key Chinese enterprise customers. The industry-wide transition to high-NA EUV lithography and advanced packaging technologies like Foveros is driving Intel to rapidly scale its Intel 18A process node to win external foundry customers. This architectural shift is critical as Intel ramps production of its Lunar Lake and Clearwater Forest processors to compete against rival TSMC packaged silicon in the high-stakes AI PC and data center markets. The primary near-term upside catalyst for Intel is securing a major, high-volume external customer for its 18A foundry service, which would validate its commercial viability and restore investor confidence in its manufacturing split. Conversely, the biggest downside risk is a further delay in the high-volume manufacturing ramp of its next-generation server chips, which would cede more lucrative data center market share to AMD. Lockheed Martin slipped 0.9%, scoring a fragile 40 out of 100. Delays in the tech refresh 3 software upgrade held up 75 jet deliveries, stalling billions in expected defense revenue. This hardware giant is now completely at the mercy of unwritten code. Our teardown reveals how this critical software bottleneck threatens their entire defense monopoly. What operating evidence matters most for Lockheed Martin Corporation? The Lockheed Martin Moat isn't just hardware lock-in, it's a software-dependent lifeline. And another question, what could weaken Lockheed Martin Corporation's Moat durability? Hardware is only as good as software execution. Here's what's on deck for markets. Lockheed Martin is under intense scrutiny before reporting earnings. Lockheed shocked the market with a 5.2% earnings per share miss, delivering $6.44 against the $6.79 estimate. This execution failure caused the stock to underperform the industrial sector by a notable margin over the last 30 days, closing last Friday at $508.77. While Wall Street focuses on their massive special operations command win, smart money is pricing in structural margin pressure. Investors are demanding to know if management can reverse this margin contraction or if supply chain friction will derail their 2026 guidance. The real guidance bottleneck is not demand. It is the thermal limit of GaN, gallium nitride, the wide-bandgap semiconductor that tolerates higher power densities than silicon. Lockheed's missile defense radars run at a physical thermal ceiling. Meanwhile, Raytheon's LTMDS, lower-tier air and missile defense sensor, the primary competing radar system, operates at a higher thermal level using advanced liquid loop cooling. This thermal gap limits Lockheed's radar detection range and tracking precision. Until Lockheed solves this packaging yield bottleneck, their hardware cannot justify the premium growth multiples Wall Street is modeling. Quarterly financials showing modest revenue momentum for Lockheed. Here's what's on deck for markets as Lockheed Martin prepares to report earnings. While semiconductor peers Texas Instruments and Intel dropped sharply last Friday, capital rotated toward Lockheed's defensive moat. The Fed rate of 3.63% and a 10-year yield of 4.57% act as a dual gravitational pull on corporate debt. Yet, the yield spread has normalized to a low level. This normalization occurs as prediction markets price recession risk at a low level. Lockheed's shield against this monetary friction is its massive, guaranteed revenue backbone. The company secured $316.6 billion in federal contract awards over the last 12 months. This includes a massive $35.14 billion DoD contract for low-rate initial production. This federal backlog insulates Lockheed from the tariff turmoil currently rattling global trade. As political headlines spark uncertainty over new tariffs, Lockheed's domestic manufacturing base remains heavily protected from global supply shocks. Lockheed's beta sits at a mere 0.11. This low volatility highlights its role as a safe haven amid social and political policy shifts. However, the underlying business is facing severe structural headwinds that threaten its long-term health. Revenue growth crawled at plus 0.3%, while EPS plunged sharply. Geopolitical tension guarantees demand, but Lockheed must prove it can convert these contracts into actual margin expansion. Lockheed Martin reported earnings per share of $6.44, missing the Wall Street estimate of $6.79 by 5.2%, a miss that raises questions about near-term guidance. Lockheed Martin is trading below its 20-day average, currently at 500. Lockheed Martin's management is leading with one phrase: superior capabilities in delivering advanced defense technology and systems. That's the headline from the earnings call. 3 words designed to make investors feel invincible. It's the kind of language that glosses over the fact that EPS missed by 5.2%, free cash flow cratered to negative $291 million, and the company reaffirmed its outlook with the kind of caution that only appears when the numbers aren't cooperating. Now, let's decode the signals management isn't highlighting. No insider buying in 90 days. That's not a red flag, but it's not a vote of confidence either. Wall Street's positioning tells a quieter story. Charles Schwab trimmed its stake by 17%, while the global ex-defense tech ETF cut 8%. These aren't panic sells, but they're not exactly doubling down. And then there's the short volume. 29.7% of trading volume was short-marked last Friday, right in line with the baseline. No spike, no squeeze, just steady skepticism. What management is saying is superior capabilities. What the lab hears is, we're leaning on legacy programs because the next-gen pipeline isn't moving fast enough. Lockheed's prepared remarks led with record demand. Strong customer demand. That's not a typo. That's a linguistic downgrade. Record implies a ceiling, strong is a floor. And while the CEO name-dropped Orion, F-35s, and missile defense, the 10Q buried a critical detail. The company's backlog growth is slowing, and R&D as a percentage of revenue isn't expanding. The momentum breakdown for Lockheed Martin. RSI sits at 50, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. The Lockheed Martin Moat isn't just hardware lock-in. It's a software-dependent lifeline. Physical hardware lock-in guarantees decades of sustainment revenue. Rising global tensions fast-track international demand for high-margin Patriot missile defense systems, securing a massive backlog competitors cannot match. Hardware strength fuels cash flow. Hardware is only as good as software execution. Lockheed faces severe bottlenecks upgrading physical systems with advanced code, essentially turning fighter jets into flying smartphones. Delays in these updates directly stall aircraft deliveries. Software lag stalls delivery pipeline. Slow-moving institutional money is wavering, with 13F filings showing Charles Schwab Investment Management trimming its position by 17%. What Lockheed Martin is saying: defense demand drives growth. What the lab hears: borrowing costs erode profit. The lab's answer is no. While the defense budget drives record demand, high capital expenditure debt service directly squeezes profitability. This friction is compounded by a neutral to bearish technical trend, with MACD displaying clear bearish momentum and volume dropping below its 20-day average. Our Moat durability score sits at 40 out of 100. Moat durability signals vulnerability. For earnings on July 23rd, if Lockheed clears its software backlog, it proves its digital transition is viable. If coding delays persist, it reveals critical execution risk. Watch resistance near $547. Breaking above it confirms a post-earnings beat, while falling below support at $500 invalidates the bullish thesis. The case against this thesis: Lockheed fails to clear its software backlog by the July 23rd earnings date. Here's the macro picture shaping Lockheed Martin. Rising global conflicts like the war in Ukraine and tensions in the Taiwan Strait are driving massive U.S. defense spending bills that directly fund Lockheed's production lines. At the same time, high Federal Reserve interest rates increase the borrowing costs on their massive manufacturing facilities, which temporarily squeezes profit margins despite this record-high demand. The shift toward digital warfare requires Lockheed to upgrade physical hardware like the F-35 fighter jet with advanced software, acting like a smartphone receiving critical operating system updates. While this software transition keeps Lockheed ahead of traditional hardware rivals like Boeing, any coding delays or computer chip shortages threaten to stall aircraft deliveries. Over the next 6 months, the biggest growth trigger is the potential approval of a massive new U.S. congressional defense budget that fast-tracks international sales of Patriot missile systems. Conversely, the greatest immediate threat is another federal government shutdown battle that would freeze new military contract awards and delay payments for ongoing projects. Standout signal? Texas Instruments durability score crushed Intel and Lockheed. What did the data miss about TXN's competitive position? Tell us below. This isn't financial advice, just engineering-level analysis for education. Markets change fast, so always do your own research. Past performance never guarantees future results, but the data doesn't lie when you dig deep. Hit subscribe for the hardest semiconductor breakdowns on YouTube. If you want our full breakdown on Rocket Lab, the link is in the description. Stay sharp, engineers.